Welcome back to another episode of How to Make Money with Hard Money, joined by my trusty partner here, Caleb Delgado.
Hey, hello, everybody.
All right. Today is it's early October 2025. So we're going to kind of chat about market conditions, the products that are out there, some different equity structures. We're going to kind of just keep it open today, but certainly the word on the street is it's a challenging market. And so we're definitely seeing a lot of that. So we're going to chat about that first.
Yeah, it definitely, it's good to talk about the challenges our clients are facing, from the lender perspective and from the borrower perspective. So, the first question is, what kind of market are we in today?
Yeah, and from lender perspective, we're obviously a hard money lender, but we also own a development company and we own a lot of real estate as well. So, we are certainly in the market from both perspectives, and we see a lot of applications. We have a lot of loans on the portfolio, so we feel like we have a good perspective, at least in the Florida market, of what's happening. It's challenging. We're going to use that word a lot today. I don't know if declining is the right word all the time. I guess we were talking about this, and I've said it before, even at an event last week. Is the market declining? Right. That's kind of like an interesting question. Is it because there are certainly sales that are down 10 to 20% in some markets,
absolutely,
from what they were 2 years ago. So does that mean it's declining? And I think it was Dave Ramsey talking about like the definition of fair market value, right? And appraisals use fair market value, and we've even said on here a lot that we see a lot of appraisals that are higher than what the property is able to sell at right now. So does that mean it's a bad appraisal, or is the appraisal using the definition fair market value, which is what one buyer is willing to buy for and one seller is willing to sell for, without distress? Right. So I think that's the key that I wanted to kind of highlight today, is without distress. So I think we're seeing more distressed sales in today's market than we have in the last 10 years.
Absolutely. And I think the biggest question we've got as of late is all about liquidity, because I think that's the soft spot for a lot of clients that's causing distress.
Yep, that's certainly one. Absolutely. And there's all sorts of, distress looks different for different people.
For sure.
I mean, it could be you have to move because you have to change jobs, locations. It could be a divorce. It could be that you're paying a high interest rate on a bridge loan and you have a balloon, a maturity. Even like we have a 10-year note on our apartment complex, and there's a 5-year balloon that's coming up next year. So it could be balloon payments.
It's forcing action.
It's forcing action. And so the need to sell is like the element of distress, and how bad is it? And so options, we're going to talk a lot about options. Liquidity is options, like you're saying.
Yeah.
So I guess like I think there's more distress sales. Personally, my perspective, I'm trying to stay optimistic in a lot of ways. I think there's more distress sales, which make it look like, if you're running comparables in 90 days, and make it look like the prices have gone down.
Yeah.
I think long term, the prices will hold, is my personal opinion. I know you share that.
Yeah, I definitely echo that. I always, there's a reason why real estate is cyclical.
Yeah.
So it'll come up, it'll come down. It's about being able to stay in the game and then giving yourself options to survive up and down markets.
Yeah. So I guess let's dive into liquidity. Like, why does liquidity matter then?
Yeah. I mean, liquidity, the biggest thing that we have is...
What is liquidity first, I guess, right?
Yeah. Well, liquidity is the amount of cash that you have with the ability to infuse it into a project. And liquidity doesn't necessarily mean your cash, because that's one of the things that we're going to talk about a lot today is creative debt structures. But, liquidity is how much money do you actually have to put involved in a deal?
Yep.
And it's cash. Right. And the cash can come from an investor or it can come from yourself, but it's the actual cash infused in the deal. And that's where liquidity is.
And I guess then why do you need liquidity? When do you need it? We're obviously a hard money lender. We're 1-year bridge loans. So how do you get off of our loan is typically a sale or a refinance.
Right.
If you're refinancing, it's typically a DSCR loan. We've talked about that before. Yep. And so if the DSCR loan, depending on where your appraisal comes in, you might need to put more cash down. Might not be because of an appraisal issue. You might have the 75, they go 70, 75% loan to value on the DSCR. And if you're at 70 with us, in theory, after closing costs, you should be netting even, especially if you built in equity. But a lot of times it's the DSCR ratio that, if they want 1.2% DSCR, which is, your debt service coverage ratio. Yeah. And right now we're seeing a lot of rents that have come down.
Yeah.
So, there's a lot more active inventory in the market for sale, when borrowers and sellers can't sell for the price they want, if they don't have that element of distress where they have to sell, we're seeing a lot of people take the property off the market. We have more, that's an actual statistic, there's more withdrawn listings.
Absolutely.
So when listings are being withdrawn, a lot of times sellers are then saying, hey, I'm going to rent this house out.
Right.
So now there's an increase of rental supply.
Yeah.
I mean, we can talk about a couple of our properties in Pasco County. We saw $300 to $400 a month that from the previous lease, the price came down.
Yeah.
So when that happens, the DSCR gets crunched. And sometimes if you're looking to refinance, you have to put more cash down on the refi.
And that's the liquidity component.
If you don't have the cash, what do you do?
Right. And then it's either you sell for a loss or you have negative equity on the deal, but banks aren't going to allow that.
Or sell for less than what you thought it was worth.
Exactly.
Which, I mean, that like literally we can say we've seen it on hundreds of loans on our portfolio right now. But also we were there ourselves. I mean, we had over 10 listings active in the beginning of this year. We withdrew all the listings.
Yeah.
Because the sale price, we know what they were worth a couple years ago and what they might be worth in the future. And we're not distressed in a manner that we have to take a much lower number. But we were surprised, by the offers we were getting based on what we thought they were.
We were completely surprised, but it goes back into what we were saying is liquidity, our ability to put liquidity and put money back into the deals helps us stabilize.
Yep.
So we can weather this market at this time where we see a lot of our clients spread very thin.
Yeah. Even like weather, that's a good, can you, can you sustain vacancies? That's another point, right?
Yeah.
Because we had a couple of units when we tried to sell them, we vacated the units and then they sit on the market for a little bit. The debt payments are still due.
Yeah.
But you have no cash flow coming in.
Yeah.
So how do you make the payment? Liquidity. Right? What if you have repairs and maintenance that are needed, a new roof, liquidity, refinance, put cash down, liquidity. So I think that's really important, or even buy the note down to where the DSCR covers. So that's kind of what we're talking about today.
Yeah.
That's optionality. Yeah. That's how you can survive tough times.
Yeah. And I think the greatest part to start, or where we should start, is really, banks for true hard money. What are the bank lenders lending at, or what are the hybrid lenders lending at versus us?
Yeah. Yeah. The institutional hard money lenders, right? I know we've talked about the securitization, but just to say it again, it's pretty new, the last 3 years. I think it started at like $5 billion 3 years ago, and then it was $8 billion last year, and now they're projecting $12 billion this year. So the industry of securitizing hard money loans is growing. What does that mean?
Yeah.
It means they're packaging loans into tranches or big portfolios and selling them on the secondary market. Who's buying those? Groups like AIG, MetLife, big insurance companies, private equity. So to buy a tranche of loans, you have to have a grading system.
Yeah.
Now, to be graded, you have to have criteria. You have to have boxes to check. Credit above appraisal, LTV, equity from the experience. These are all borrower qualifications and deal qualifications that then get graded.
Yeah.
So that's that world. We're DKC Lending's an asset-backed hard money lender. We're private. So we don't sell our loans on the secondary. You don't need credit, liquidity, appraisal, experience. We service all of our own loans. So like the market in hard money has divided, and there's two different products. So where's the money coming from? It's very important for borrowers to understand.
Right. And the origination of the money is absolutely a pivotal point that borrowers have to understand, because you can't expect to navigate tougher markets and not know where your money's from. Right?
So a lot of people, what are the difference in the products then? Okay, so the institutional hard money, what kind of terms on a fix and flip versus?
Yeah, so a lot of it has to do with leverage. So when you go to the institutional lenders, the criteria, first off, you're going to have to show your credit, you're going to have to get appraisals, you're going to have to show liquidity of 6 months bank statements, or maybe not 6 months bank statements, but 6 months of liquidity that you can carry the notes. You have to have a credit score above 680. You got to have experience on paper with your LLC. You can't just say, oh yeah, I flipped 10 homes this year, and you don't have no experience with the LLC that you have. You have to actually show it. So when they're using that, they'll grade it to the quality of the loan.
What's some LTVs they're doing?
But that's the tough part with the LTVs. It's 90 and 100. A lot of these institutional lenders are giving out, which doesn't leave very much room for mistakes. At that point, you're kind of tying your hands that if anything happens bad with the deal, it can default pretty easily.
Especially for the lender, more so. I think the lender is the one that's
holding the bag there.
Yeah, taking a lot of risk there.
Yeah, and then so the lender's holding the bag there, so they really have to monitor the clients, and the clients have to operate at a very high level to make it out successfully. And then two, if the market adjusts, which that's what we're facing now, and a lot of people are going through it, is, we're gonna have a 10, 15% market correction. Well, if you have a 90% loan and there was 10% equity and you just lost 15% in the market.
Hopefully there's some equity that was gained through the flip, so you're probably breaking even or something like that in a flip scenario. But yeah, the leverage point is it, because the 90%, so why would somebody use, private? We're doing 70% acquisition and 50%. We don't do a lot of fix and flip loans right now. No. Not because because it's not a good product. I think it's because the margins are so slim on fix and flips right now that you have to have limited cash in the deal, because the less cash you have in the deal, the less profit you can take, and your cash on cash return is still strong.
Yes.
The more cash you have to put down, the less, the more return you need.
Yep.
So what we're seeing is a lot of refinances, people growing their portfolio with fix and leases, and a ton of new construction where there's, bigger margins.
And people have to understand too, in these markets, you have to really be aggressive with your offers. I know it's been a tough transition for sellers, getting used to what prices are today. And, realtors and other real estate professionals have to guide their clients to let them know what property is really worth today. And that's been a very difficult thing for people to navigate. But as a buyer, you have to make sure you're buying right. The deal is made the day you buy. I mean, there's mistakes along the way if you're fixing and flipping and rehabbing, don't get me wrong. But you can navigate that if you've purchased right. And people really have to dive into the comps, where before you can look out 180 days, especially in the state of Florida. I think it's important that people really assess their comparables a little bit tighter. And that's what we've been doing.
Even I'd add to that and say, we look more at the active inventory than we have ever before as well.
Yeah.
Because I'm seeing comps in 90 days that sold, but then you see an active comp that's, the same house listed for sale for $40,000 less and can't sell.
Yeah.
So now, even if you look at your 90-day comps, you really have to look at the active inventory as well. And that brings in the level of distress too, because if the seller doesn't need to sell and they're sitting on a 2.5% mortgage, they're probably not going to take that lower offer.
No.
But it's a numbers game at the end of the day.
Yeah.
So I think that's important. The securitization of hard money lending, just to wrap that up, is like there's more cash coming into the hard money lending market, which is driving the price down. We've said that before, but if you're going to get, you can get 10, 11 and a half, 12% interest, depending on your criteria, 2 to 4 points. Still, the points are pretty similar overall, but you're getting higher leverage. I think the thing that people don't always talk about is the risk tolerance. To take on a 90 and 100%, and you said it too, to take on 90 and 100, the borrower is taking on a lot of risk there. Yep. You mentioned that there could be cash coming down, but you don't have any liquidity. If you take 90 and 100 and you have a lot of liquidity as a backstop, then that's different. But I'm seeing a lot of borrowers taking the 90 and 100 type loans and they don't have liquidity.
Right.
So that's kind of where they can get jammed up. And it doesn't have to be your cash, as you mentioned earlier. Yeah. It could be an investor's cash, but I think that right now we're seeing a lot more borrowers, putting more cash down because it puts their loan in it reduces the risk for the borrower.
Yeah. And one of the big things manageable. I've seen for talking about successful products and not successful products, the type of borrowers I see navigating successfully the 90 and 100 have a lot to do with velocity.
And experience.
And experience. Experience is huge for people in those scenarios. You have a first-time flipper taking out that type of leverage, it's extremely dangerous in today's, because you got to remember, these subs have to move quickly. You have to have the right subs on the job. They have to be able to perform at a high rate with top-end quality, because the type of deals that are selling, you think you're going to get away with C+ average quality of work? No way.
Great
you
point.
have to have A++ work. You have to work faster than you've ever had and turn through that property quickly. And that velocity.
The velocity on the sale too.
Oh my God. So the right realtor group that's selling, the active strategy that you have to get off the property, all of that matters. And the margins are so tight that if you make one mistake, it could blow your entire deal.
Yep.
Now, going back to your saving grace, if you have liquidity, you can weather that storm, put down more money and get through it.
Or refinance and maybe hold the asset if you can't get the sale. Because you go, those deals, we used to be getting into the fix and flips, you're getting in and out in 6 months or less.
Yeah.
Some 6 months, maybe 8, but Now, if it sits on the market for 6 to 8 months, is like, depending on which market you're in,
Yeah.
we're seeing every bit of 6 to 12 months of inventory. And then we're talking about Florida. You know,
Right.
I'll say that again. We're talking a lot about Florida today.
Right.
It's different in every market. And I'll tell you, the market from Tampa is different from Fort Myers, which is different from Pasco County, which is different from Lakeland. So there's tons of sub markets. You have to know your market as well. So we're talking a little generic, but you know, we're seeing 6 to 12 months of active inventory. So to get in and out of deals is very difficult. That's why there's less fix and flips in the market.
Yeah. And going back to what you're saying about the inventory, having that involved in the transaction and underwriting and the overall overview of the deal is important, because think about it. If before, when deals were selling inside of 1 month, well, typically what is that in interest to the client? Typically around 1%, right? That they have to allocate to the deal, that as long as they have that extra 1% to get through the sale process, they're fine. They make the profit on top of it. But when you adjust to average days on market, 6 months plus, 6% more on your deal is a big swing.
Oh, yeah.
When you're talking about, that could be all your profit for all you know. I mean, typically you want to be around 15% at least to do a fix and flip or something.
Maybe in like a 90-day cycle, because really you're looking more like, you're looking 15, if you say 15% probably on that deal, and you want to turn that same cash maybe 3 times a year.
Right.
So you want to really be closer to 50% annually on those flips.
So it gets
30 to
dangerous.
50. Yeah. So I guess that's certainly a challenge. I guess one option, if you don't have the cash, you know, we were asked that a lot, even at the event last week, was how do we get in the game as a new investor if you don't have a ton of cash? And that's where learning equity structures and different joint venture models really can help newer borrowers get in the game. We're not saying you have to have cash yourself. We said bring in equity partners. And a lot of people don't know how to do that.
Yeah, and that's where I talked about the fallacy when me and you were talking before of, I can get involved in real estate, 0 money down. I don't have to bring a penny to the table. I keep telling people all the time, that's a fallacy. That's not real.
Yeah.
When you're involved in real estate, or typically almost any business, you have to have money. Now the question becomes, is it your money or someone else's?
Yeah.
You know, always use other people's money. That's fine. Yeah, but there's the lender's money. There's your money. There's your investor's money.
Yep.
So there's different buckets of capital that you can tap into to have limited capital in the deal.
Yep.
But you know, you handle all of our development deals and all of our debt structures. I mean,
Equity structures,
equity structure, but the debt structure overall. But you know, the capital stack, as they say.
Yep.
So what would a capital stack or a successful capital stack look like in today's market?
Well, there's a lot of options.
Yeah.
Every deal is different. And I think that's a fair point as far as why do you bring in equity partners? You know, we see a lot of borrowers that are asking the lender to hold too much risk, especially on the private side. You know, yes, there's those institutional loans that do get high on the leverage, but they're also running credit, liquidity. There's all those other criteria. When you're coming to a private lender that's lending based on the asset, it costs us up to 25% to default and take an asset back. Right. So the minute you're at 90% and they default, you lose money. Whether it's income, principal, like you lose money.
Yeah.
Even at 70% LTV, you're very tight. You're very tight on the sales. If there's a market correction, you lose income as well.
Yeah.
So that's why that's 18% default interest, 1 year attorney fees. That's where the 25 industry wide. That's where the 25% takes 5% to transact the asset. That's why most hard money lenders are 30% down.
Right.
It's very common to be asset-backed lender to have 30% down. So that's where those numbers come from. If you're asking the lender to hold more risk than that, especially on new construction development, you know, they if it's me, I'm looking for equity, you know, because now you're asking us to hold the risk. And so that's not what a lender does by trade. Right. The lender provides debt. The developer holds the risk of the project being successful or not. And that's why they make more money. They have more upside than the lender. So I think that's really important to understand, is that you can't ask the bank, the lender, to hold the risk of a development project. And it's crazy how often we see that, you know, and that means you have to have cash.
Right.
Especially in new construction.
Right.
You have to have cash. And whether it's, even if you're getting a higher leverage on new construction, you have to have cash for closing costs.
Right.
You got to be able to pay debt payments. You know, you can't ask the lender to pay their own interest payments, right?
Oh, yeah.
You have to have money for interest. You have to have money for closing costs.
Right.
And then a lot of times, if there's draw schedules, you have to have money to bridge the gap between draws. You
front the draws.
You front the draws. We're talking a lot about new construction internally. And, you know, on new construction, the front end is difficult for borrowers without liquidity, because how do you you got to order the windows before you need them. Lenders give credit once the materials are installed.
Right.
That means trusses, framing, windows. These items you have to buy. I'm buying windows right now. They're 8 to 12 weeks, depending on where you're getting them out.
Right.
So you need to order them before. You got to put deposits down. There's a lot of ways to do that. You can negotiate the net pay period for subcontractors.
Yeah.
You can negotiate with your vendors how much deposit you put down. I mean, we ordered a truss package the other day. Can you put 20% down, or you have to put 50% of the truss package down until delivery?
Right.
So these things, you have to have cash at the end of the day. You can't do big projects without cash.
Right.
And so that's when, if you don't have the cash, bringing in the equity. So sorry, I had to say that because I think it's crazy how often we see that.
No, and I get it all the time when everyone's like, oh yeah, you're not paying my draw. That's why I took the draw schedule. I'm like, no. I'm like, go to any lender in America. You pay for the upfront costs and then you get reimbursed. It's always a reimbursement.
Yeah.
It's just like when you collect interest versus rent. A lender, you actually have to use the days of your interest before a bank can charge you. Where rent, you pay your rent in advance of the time.
Yep.
It's the same with a draw schedule.
Yep.
It's you front the money for the construction for that draw, and then when you finish the draw and you have completion, your pictures and inspections and everything, you give it to your lender, they reimburse you 100% of that draw.
Yep.
And people make the mistake all the time when they sit with me. They're like, Caleb, oh yeah, you're going to pay for that, right? I'm like, no. You could use a credit card. You can, have those payment schedules. You could use all those creative things. I think one of the big things to talk about is how do you raise equity, or, who do you look for to, what type of investors would invest in equity on a real estate project?
Yeah. Well, it starts with a good deal. You have to have a good deal.
Okay.
You have to be able to illustrate that it's a good deal because, I do it in spreadsheets often. We have to say, this is a good deal for these reasons. Here's the data to support the purchase price, the sale, the construction cost, the holding cost. This is my pro forma, right? So you need to have a good deal. You have to be able to illustrate it. And then you have to have an attractive offering for the equity partners. And that's the thing. A lot of people, it is a little, I don't want to use the word greedy, but it's like, I want no cash in the deal and I want all the profits. A lot of times you can't do that because if you don't have the cash, you have to share the profits with somebody who does have the cash. Absolutely. And look, we do that all the time. Yeah. I told you last time, I mentioned, I never have done a development deal without a partner. Right. I've had partners on all my deals.
Right.
And so I think that's a strategy. Like, partners are good. It shares risk. Also, you're spreading risk. You have an extra set of eyes on the deal. So I think there's a lot of great things. Partnerships are fantastic, but the lender is your lending partner. So the equity partner is different. So how do we structure it? What type of returns? And it's different for every investor that may invest in a deal. But what type of returns are they looking for? Have those conversations with, from a lender world. I know investors can own mortgages for, call it 10%. You can own a mortgage. You're the bank. You're in a less risky position, right? It's passive. It's paid monthly. It's so if you're, that could be a benchmark. If you're flipping the home, you said it, you want 25% returns at least. If you're building, I see builders wanting 35% returns minimum. So what type of work are you doing? Are you getting paid? What type of risk do you have? These are all factors that are considered in the equity structures. So I think I'll give you one that we use a lot. It's like new construction. That's an easy one to just talk about. We're doing a lot of new construction deals. Most borrowers are doing new construction right now in the market. Buying the lot, a lot of times having an equity partner purchase the land.
Right.
Because you don't necessarily, if you don't want to have to be making interest payments on the land.
Right.
You're not ready for permitting yet. There's a gap between buying the land and often having permit in hand ready to build. So if you're making interest payments on that, it can get expensive for your project. So can you have an investor buy the land, then you use a lender to collateralize the land and give money for the construction?
Yeah.
That's a great model. We see it a lot. We do it. So investors, okay, how do you buy the land? How do you compensate them for coming up with the cash to buy the land?
Right.
Well, if you are the developer, if you can source the land, bring the financing in through a lender, manage the construction and disposition, that's a good package to offer an equity investor. Hey, you're a passive investor. You buy the land, you put the cash up, we'll do the work. Well, what's the splits look like? A lot of times there can be a deferred interest to that investor. So they're guaranteed, they can call it pref equity, but they're guaranteed a return, an interest return on the cash at the end of the project. Okay. So you don't have the stress of having to come up with the cash up front. Yeah. So deferred interest, preferred equity, then a profit sharing of the profit.
Gotcha.
A lot of people will ask, well, how much do you give them on the interest versus do you give them the same as the lender? How much do you give them versus the profit? I think every deal is different. Every investor is different. But I think a general rule of thumb that I often say is that the higher the pref equity, the higher guaranteed return for them, the lower the profit sharing could be. And I think if you really believe in the deal and it's a great deal, and you're going to put all, how much experience do you have too, by the way,
Right.
you have,
That matters.
If you have 10 sample size, you're like, I've done this 10 times. I'm very confident this is the 11th. It's going to be similar to this. You can offer a lower pref return, or sorry, a higher pref return and a lower equity, and you can take the lion's share of the profit.
Now, can you explain the difference between the pref equity and actual equity? Or
yeah, so the pref equity is the guaranteed return. It's like you can consider it like an interest return that's percentage of the money they put out.
Gotcha.
And then the equity would be a profit sharing.
Right.
Whatever money's left after you pay back the loan, pay back their equity principal, pay back all the holding costs and the construction costs, whatever is profit after closing costs, that's a percentage split.
Got it. So for an investor coming into that, they could expect two forms of interest for them, right? It's not just, we could splitting the equity, but you could do that as well.
Yeah, you could do just equity return also. It's a good point. Yeah, you could do, hey, put all the cash up and you get 50% of the profits, or put all the cash up, get a 12% pref return and a 20% equity profit. Right. So you can kind of splice it. And it's all math at the end of the day.
Right.
And how do you get to the number they're looking for? And then what's the risk to get to that number?
Right. And I think also it's good for people to understand too, when they're taking on a partner with those preferred equities, what their PG is worth. Because sometimes they won't, a lot of those investors will not want to sign one, or some of them will for additional capital.
Yep.
So,
Absolutely. Yeah. The PG, there's a cost to having a PG on there. Also, if it's a good PG, it provides a lot of value to the lender. You can maybe get higher leverage sometimes with better PGs.
Yeah.
So
I've even seen contractors at this point for the first time in a long time, where contractors or lenders are requiring contractors to have liability onto these projects.
Yeah.
So they can't just walk away. So I've seen some contractors, one, they have to get an extensive background check on themselves to make sure everything is good, their financials are good, and their credit's good, and they have to sign a PG. So I've seen a lot of that happening as of recent.
That's a great point. When you see that, I know it's a lot of times in capital markets, when we're the broker in the transaction. How does the contractor answer that call? Like, are they, yeah, no problem, I'll do it. Yes, I'll do it, but I want equity. Like, what's the conversation like a lot of times?
So it changes the whole dynamic of the deal. Because the second the risk becomes higher for the contractors typically want to do their job and leave. That's what they want to do majority of the time. But now that's putting them in the position to really be involved in the equity of the deal. So I see a lot of contractors just say no. That's the first thing. Majority of them say no. But the ones that do say yes, who I would like to say that they see the future, they see the light at the end of the tunnel, they believe in the project, and they do trade for equity.
Yeah.
That conversation, it automatically changes. What are your profits? All right, you're projecting this. Now I want this percentage because I'm going to sign a PG.
I love that.
So they change immediately.
I think it's a great structure too. If you're the developer and you can bring in a general contractor and give him an equity piece, and then also have an equity partner putting the cash up, give him an equity piece. That's a really good partnership right there. The contractor is aligned with the project. I think alignment is huge on these projects. The person putting the cash up, they want it to be successful because they're profit sharing. You want it to be successful. Obviously, you're the developer, you're profit sharing. And then now the contractor, they're motivated to build faster, cheaper, because they're participating on the profit at the end. So I love that. It brings a lot of alignment. I think it's a great structure.
Yeah, I think those are the most successful relationships and partnerships I've seen as far as our clients.
Yeah.
The best guys everyone is tied into the success of the project. And when you have everybody tied in, that's a recipe for success in my opinion.
I think also I want all the profit. I know you do, but maybe do 2 deals instead of 1 and participate with equity partners. It's
and that's the hardest discussion I think on the sales side that we've had as of recent is going to a client who is really trying to have a lot of velocity to earn the income that they want for their family and the growth of their future, but having to tell them, hey, you're spread too thin. That's been a very difficult conversation because who am I to tell anyone what to do? But at the same time, the numbers never lie. And when you see people having inability or struggles to make their interest payments, struggles to pay full of their draw,
taxes,
taxes, insurance, all the things in between. Or the first telltale sign is, oh, can we do this draw in half? I can only get through half of the draw. Well, why? Is it that there's a complication in the project? 9 times out of 10, as of recently in today's market, it's been, I just don't have enough money to finish the draw, come out of pocket for the draw, and get reimbursed.
Yep.
And these are big advantages. Talk about how to make money with hard money. These are the advantages.
Yeah.
The advantages of the relationship makes a big deal now. Because now if you go to a bank, and anyone who's listening, try to get a revision on a draw schedule with a direct lender. Tell me how that works
With
for
the
you.
bank, you mean?
Yeah, with a bank, with a direct bank. Try to go in there and tell them, hey, I'm having liquidity issues. Tell a bank that and see what happens with your loan. They're not going to help you. They'll default you immediately. Well, they may not immediately, but they're gonna be making precautions to guard themselves.
Yeah.
That's where the hard money relationship, true asset-backed lending, is so powerful because
We
liquidity.
do draw revisions every single week.
Talk about it. Give me the draw.
Keep borrowers moving because we're the lending partner, but we want to keep them moving.
Right.
It's such a good point. I mean, yeah. So I think that's a huge event. I would even say extensions too. I mean,
Yeah.
the amount of extension requests we've had, they're 1-year notes. So an extension means you need another year, another 6 months, whatever. You need more than the 1 year.
Mm-hmm.
Why? Project didn't move as fast, couldn't sell as fast, couldn't refinance as fast, couldn't stabilize as fast. Whatever the reason is, couldn't get my credit to where it needed to be. You need an extension. If you don't have a lender who's willing to offer one, you end up in foreclosure. When
Right.
you're in foreclosure and you need to sell,
Good luck.
investors will lowball you on the sale price. When you're in foreclosure, good luck trying to refinance. Let me know what those terms look like.
Yeah.
So you're in a bad spot when a foreclosure happens. So if the lender you're working with doesn't offer extensions,
Right. Well, one of the biggest things I'm seeing again is when people get caught in that extension process and the lender, which a lot of these lenders have taken extensions away, they won't even offer them. And if they're offering them, they're 3 months at,
very expensive terms.
very expensive to do. So we're getting a lot of phone calls. Hey, I need another year in this project. Can you refinance me? When we negotiate the original side of the loan, the origination of that loan, a lot of people don't take into account if they don't make it. Now, if you don't make it and then you have to call us secondarily to refinance you, you have all the closing costs again. You have all the points again. Now, couldn't your deal have the equity to sustain that cost? Majority of the time, they don't, unless you really, really bought well. That's another conversation I have with people. I'm like, okay, you may think just on paper that loan is a lower interest rate, and they might have 1 point lower. So what? What happens if you don't make your deadline and you got to do that refinance and you're forced to do a refinance with another lender and you're calling me after the
cost
fact,
you 8 times as much
and your deal is gone and you're blown, and now you're just trying to salvage the money that you've put into the deal.
to not get your personal guarantee ruined
Destroyed.
and have a bankruptcy on your hands.
And then people are like, no, I can make it. And it's important for people to be realistic. We all want to see the end of the rainbow and the pot at the end of the rainbow, and we all want to be super optimistic about everything. But at the end of the day, you have to be a realist. And that means accounting for anything that can go wrong.
Yeah.
So if you think that you're not going to need an extension and you're not planning for an extension in any capacity,
Yep.
big mistake.
Optimistic but realistic. I love it.
You told it to me
Yep.
yesterday because I
Yep.
was talking a little
No, it's great. And I think so we're offering extensions, but you have to be able to make your interest payments timely. You have to be able to make your property tax payment. You have to be able to pay your insurance binder because, we often have 1-year insurance premium paid at the original closing.
Mhm.
When the 1-year term's up, your premium's up. So that's where it can really hit people hard when you just use a $250,000 property or so, or loan size, whatever you
Right.
want. You got a $2,500 payment. You have a couple grand worth of extension fees, perhaps. You have probably a $2,500 tax payment, if not higher.
Right.
You probably have another $2,500 in insurance premium.
Mhm.
And now, if you don't have liquidity or you're in the middle of a project, that can be a tough month.
Right.
You're going to need to bring cash in
Right.
some manner, and to ask the lender to pay your insurance, pay your tax bill. I mean, that ends in default, by the way.
Well, that's an automatic default according to the loan docs.
Automatic.
Yeah, and that's standard for any lender.
So just having that optionality keeps you in deals too. Keeps you out of foreclosure. So
Yeah, and even at that time, say you don't have an equity partner at that time, it's not like we're forcing or saying or promoting you have to have an equity partner. But sometimes if your liquidity is tight and then you get into that extension process, you might have to take an equity partner at the end. So it's like you were faced with that from the beginning. You should have did it from the start.
We've seen a lot of creative moves. I mean, bringing equity partners in is a good one. Whether you have like IRA accounts, stocks, or life insurance, cash value life insurance, anything as a rainy day fund of some sort. So liquidity can come in a lot of different forms.
Yeah, liquidity. Yeah, that's it. And liquidity is the answer in today's market for a lot of the challenges.
Yeah. So it's a tough market. I mean, there's a lot of there's still optimism in the market. I think we're seeing more activity right now in Florida. We're getting past hurricane season.
Thank
so
God.
I think after last year, that's definitely a big hurdle to have a good season under our belt. Hopefully, there's a couple more rate drops. The first one wasn't too significant. The quarter point didn't really help rates that much.
Yeah,
but I think there's some optimism there.
Yeah.
But we'll see where the market takes us. I don't see it turning around and becoming sunshine and rainbows overnight. So I think it's a market that you got to be pragmatic and have options in.
Yeah,
for the foreseeable future.
I couldn't agree more. I think that's where the market is today, and it's kind of a little bit more stabilized. And like what you were saying before about what's truly distressed versus what's not distressed.
Yeah.
And we've said, having high interest debt is a form of distress that's been forcing people to get through transactions or refinance and liquidity issues. It's been a little bit of complications, but overall it is a challenging market. I think we're a little bit more stabilized and predictable to certain degrees.
Yeah.
And
more certain than it was a year ago, but still there's a lot of uncertainty.
Oh, for sure.
But I think I think we shot a podcast about like survive till 25. I think we're gonna have to go back and revise this. Survive till 27, 26. I don't know. So just be pragmatic, make good decisions, have options. That's the key. And give us a call if you want to chat about a deal here.
Exactly. Go with a lender that's willing to really build a relationship with you and navigate it with you.
Yep.
You don't want a lender that's so rigid to the point that you can't make creative solutions. Because creative solutions in challenging market is a massive key to success. And if people don't understand that, just go through the experience and you'll learn very quickly.
Yep.
And your pocketbook will feel it first.
We'll end it there then for today. We'll be back. We'll be back in another month or so, and we'll see if there's been any changes in the market. But great conversation today. Thanks everybody for joining us. Appreciate it.
Bye-bye.
Thanks for joining us for another episode of How to Make Money with Hard Money. Like, subscribe, follow us on all social media platforms. You can catch this podcast on Apple and YouTube.